Key takeaway. Tariffs are more than just economic levers. They're also bargaining chips for the US in negotiations. The message: cooperate to avoid tariffs, or risk economic instability and devalued assets sold off to opportunistic investors. Notably, major players like Warren Buffett, Bill Gates, and Mark Zuckerberg are reportedly holding large cash reserves waiting to buy assets at attractive prices. This latest round of tariffs is testing countries' responses. Surprisingly, many have pushed back not by complying, but by selling us debt, which led to falling bond prices and a weaker dollar. Rather than pouring money into the US, global capital is now flowing out. What does this mean? Many countries are choosing to endure financial turbulence rather than submit, marking a significant shift in the global economic landscape. With stocks, the dollar, and bonds all under pressure in the US, stabilizing one area often just shifts strain elsewhere. Even the Federal Reserve seems hesitant to intervene too aggressively, reflecting the uncertainty of this new era. What if stocks, bonds, and the dollar all fall at once? The US government could be forced to take drastic measures, potentially triggering a global financial crisis and an economic reset, one where the burden often shifts to other countries. Why have US stocks dropped so quickly? Leverage explains much of it. For example, if you buy a $100 stock that rises to $200, you might borrow against it to buy more shares. If the market plunges due to tariffs or other shocks, banks issue margin calls. If investors can't pay, stocks are liquidated, driving prices even lower. This domino effect leads to panic selling, not just of US stocks, but of other assets like European equities, oil, or cryptocurrencies, as investors scramble to raise cash. This drains liquidity from markets, causing a crunch and further price drops, a vicious cycle that can spiral out of control. The solution? Central banks often step in, injecting funds and stabilizing markets. Still, the timing and effectiveness of this intervention are uncertain, and the wider consequences of such crises are hard to predict. The Federal Reserve's main tool for stabilizing markets is its ability to expand its balance sheet and inject liquidity. The Fed generally has two options. The first is to cautiously print money while keeping interest rates high. This might prevent steep market declines and trigger a modest rebound, but any recovery could be weak or short-lived. More likely, however, is that the Fed waits until a crisis worsens before acting aggressively, as it did in 2008 and 2020 by printing large sums and offering near-zero interest loans to major institutions. This influx of capital enables well-positioned investors to buy up undervalued assets worldwide. Such measures serve both the Fed's stakeholders and the government. By stabilizing the US faster than other economies, America retains its safe haven status and attracts foreign investment once markets settle. For institutional investors, these conditions offer a major opportunity. During global sell-offs, they can borrow cheaply to acquire discounted assets, further consolidating US control over domestic and global resources. Lower rates also help ease debt burdens. This dynamic may explain why investors like Warren Buffett have trimmed bank stock holdings, anticipating that banks could suffer in a crisis due to loan defaults and liquidity strains.